The demise of the investment bank Lehman Brothers on September 15, 2008 sparked an economic downturn that was felt throughout the world. The crash led to the worst recession since the Great Depression. It illuminated the dangerous corporate culture that had existed in banking for many years, explaining something as tangled and multidimensional as the 2008 financial crisis is fraught with difficulty. The meltdown was one of the most critical events in American history, and its aftermath saw plenty of hardship. It wiped out some $11 trillion of the nation's wealth and destroyed more than 8 million American jobs by September 2009. It froze up the nation's vast financial credit system, leaving thousands of firms too short of cash to operate. It also forced the federal government to spend $2.8 trillion and commit another $8.2 trillion in taxpayer funds to bailing out crippled corporations such as General Motors, Chrysler, Citigroup, Bank of America, AIG, and a host of other too-big-to-fail companies run by corporate panjandrums. What exactly went wrong in the case of the Lehman Brothers? The foundation seemed firm, so how did they have a downturn that crashed not just a community, but the world's economy? Keep watching to find out.
Lehman Brothers suffering a spectacular downfall.
Early days, other Roman brothers. Lehman Brothers had humble origins, tracing its roots to a general store founded by German brothers Henry, Emanuel, and Mayer Lehman in Montgomery, Alabama in 1844. Farmers paid for their goods with cotton, which led the company into the cotton trade. After Henry died, the other Lehman brothers expanded the scope of the business into commodities trading and brokerage services. The firm prospered over the following decades as the U.S. economy grew into an international powerhouse. But Lehman faced plenty of challenges over the years. The company survived the railroad bankruptcy of the 1800s, the Great Depression, 2 world wars, a capital shortage when it was spun off by American Express or AXP in 1994 in an initial public offering, and the long-term capital management collapse and Russian debt default of 1998. Despite its ability to survive past disasters, the collapse of the U.S. housing market ultimately brought Lehman to its knees, as its headlong rush and greed to get into the subprime mortgage market proved to be a disastrous step. When the greed began, the company, along with many other financial firms, branched into mortgage-backed securities and collateral debt obligations. In 2003 and 2004, with the U.S. housing bubble was well underway, Lehman acquired 5 mortgage lenders along with the BNC Mortgage and Aurora Loan Services, which specialized in Alt-A loans. These loans were made to borrowers without full documentation. At first, Lehman's acquisition seemed valid. Moreover, the real estate business enabled revenues in the capital markets unit to surge 56% from 2004 to 2006. This made the firm securitize $146 billion of mortgages in 2006, which is a 10% increase from 2005. Lehman reported record profits every year from 2005 to 2007. In 2007, it announced $4.2 billion in net income on $19.3 billion in revenue. The miscalculation. In February 2007, Lehman's stock price reached a record of $86.18 per share, giving it a market capitalization of nearly $60 billion. But by the first quarter of 2007, cracks in the U.S. housing market were already becoming apparent. Defaults on subprime mortgages began to rise to a 7-year high. On March 14, 2007, a day after the stock had its biggest one-day drop in 5 years on concerns that rising defaults would affect Lehman's profitability, the firm reported record revenues and profit for its fiscal first quarter. Following the earnings report, Lehman said the risks posed by rising home delinquencies were well contained, and would have little impact on the firm's earnings. The beginning of the end. Lehman stocks fell sharply as the credit crisis erupted in August of 2007, with the failure of two Bear Stearns hedge funds. During that month, the company eliminated 1,200 mortgage-related jobs and shut down its BNC unit. It also closed offices of Alt-A lender Aurora in 3 states. Even as the correction in the U.S. housing market gained momentum, Lehman continued to be a major player in the mortgage market. In 2007, Lehman underwrote more mortgage-backed securities than any other firm, accumulating an $85 billion portfolio, or 4 times its shareholders' equity. In the fourth quarter of 2007, Lehman's stock rebounded as global equity markets reached new highs and prices for fixed income assets staged a temporary rebound.
I wake up every single night thinking, what could I have done differently? In certain conversations, what could I have said? What should I have done? And I have searched myself every single night.
However, the firm did not take the opportunity to trim its massive mortgage portfolio, which, in retrospect, would turn out to be its last. Going towards failure. In 2007, Lehman's high degree of leverage was 31, while its large mortgage securities portfolio made it highly susceptible to the deteriorating market conditions. On March 17, 2008, due to concerns that Lehman would be the next Wall Street firm to fail following Bear Stearns' near collapse, its shares plummeted nearly 48%. By April, after an issue of preferred stock which was convertible into Lehman shares at a 32% premium to its current price yielded at $4 billion, confidence in the firm returned somewhat. However, the stock resumed its decline as hedge fund managers began to question the valuation of Lehman's mortgage portfolio. On June 7, 2008, Lehman announced a second quarter loss of $2.8 billion, its first loss since it was spun off by American Express, and reported that it raised another $6 billion from investors by June 1. According to David P. Belmont, the first also said it boosted its liquidity pool to an estimated $45 billion, decreased gross assets by $147 billion, reduced its exposure to residential and commercial mortgages by 20%, and cut down leverage from a factor of 32 to about 25. It was already too late. These measures were perceived as being too late. Over the summer, Lehman's management made unsuccessful overtures to a number of potential partners. The stock plunged 77% in the first week of September 2008, amid plummeting equity markets worldwide, as investors questioned CEO Richard Fould's plan to keep the firm independent by selling part of its asset management unit and spinning off commercial real estate assets. Hopes that the Korean Development Bank would take a stake in Lehman were dashed on September 9, as the state-owned South Korean bank put talks on hold. The devastating news led to a 45% drop in Lehman stock, along with the firm's debt suffering a 66% increase in credit default swaps. Hedge fund clients began abandoning the company, with short-term creditors following suit. Lehman's fragile financial position was best emphasized by the pitiful result of its September 10 fiscal third quarter report, facing a $3.9 billion loss, which excluded a $5.6 billion write-down. The firm announced an extensive strategic corporate restructuring effort. Moody's Investor Service also announced that it was reviewing Lehman's credit ratings, and it found that the only way for Lehman to avoid a rating downgrade would be to sell a majority stake to a strategic partner. By September 11, the stock had suffered another massive plunge, 42% due to these developments, with only $1 billion in cash by the end of that week. Lehman was actually running out of time. Over the weekend of September 13, Lehman Barclays, and the Bank of America made a last-ditch effort to facilitate and take over the former, but they were ultimately unsuccessful. On Monday, September 15, Lehman declared bankruptcy, resulting in the stock plunging 93% from its previous close on September 12. Lehman stocks plunged 93% between the close of trading on September 12, 2008 and the day it declared the bankruptcy.
And I believe it happened because greed took over and the returns were so big and so many people were making so much money that they lost all fear and risk did not become a factor in doing anything.
What ensued was the largest and most complex bankruptcy in American history. But that doesn't do justice to the damage Lehman's demise caused the financial system. The implosion of Lehman Brothers and the mayhem it unleashed was the most terrifying moment for business and the U.S. economy. Where are they now? Former chair and CEO Richard Fuld runs Matrix Private Capital Group, which he founded in 2016. The company manages assets for high net worth individuals, family offices, and institutions. In years following the collapse, Fuld acknowledged the mistake the bank made through the remain critical of the government for mandating that Lehman Brothers file for bankruptcy while bailing out the others. In 2010, he told the Financial Crisis Inquiry Commission the bank had adequate capital reserves and a solid business at the time of its bankruptcy. Erin Callan, now Erin Montella, became Chief Financial Officer at the age of 41 and resigned in 2008, following suspicions she had leaked information to the press. Her LinkedIn profile lists her as an advisor at Matrix Investment Holdings. Other stints include 6 months serving as head of hedge fund coverage for Credit Suisse and co-founding a nonprofit that provides paid maternity leave to mothers. Lehman's collapse rolled global financial markets for months, given its size and status in the US and globally. At its peak, Lehman had a market value of nearly $66 billion, which was wiped out in the months leading up to its bankruptcy. That's it for this video. Thank you for watching till the end. See you in the next one.